Welcome everyone, and thank you for attending today's Jindalee Lithium Investor Webinar. I'm Lucas Robinson from Investor Relations Consultancy Corporate Storytime. Jindalee is advancing the development of the 100% owned McDermitt Lithium Project, which hosts the largest lithium deposit in the USA located on the Oregon-Nevada border. This week, Jindalee released a pre-feasibility study for the McDermitt Lithium Project, and today I'm joined by Jindalee's CEO Ian Rodger and Executive Director Lindsay Dudfield, who will present some of the outcomes from the PFS, highlighting the path towards the development of McDermitt as a multi-decade battery-grade lithium chemicals project. Ian and Lindsay will be providing an investor update, which will then be followed by a Q&A session. And without any further ado, I'll hand over to Ian and Lindsay.
Well, thanks everyone for joining us today. Really excited to share the results, the PFS for McDermitt, which has been, I guess, the culmination of over 18 months of work. So let's get into it. I'll skip over this one. Look, in terms of disclaimer, we're making forward-looking statements. I think the other key point is all the currencies we refer to today are in US dollars unless otherwise denoted, and it's really just a summary of the PFS report that went out on the ASX earlier this week, so it really needs to be read in conjunction with that. In terms of the PFS, it just really highlights the strategic importance of the McDermitt project to the US battery value chain. You know, those numbers across the screen there really demonstrate the large long life production that McDermitt potentially has in the bottom half of the cost curve, and these are the precise parameters that potential partners on the project have told us are important. Importantly, the project is expected to generate healthy cash flow margins even in today's soft pricing environment. And I won't talk too much today about the market, but more on the PFS. But I think it's important to highlight, the current market conditions are broadly understood to be unsustainable. The pricing is below incentive pricing. As a result, we've seen projects delayed and production shut in. Just recently in Western Australia, a number of mines announced care and maintenance. On the flip side, the demand is chugging along nicely at 15 to 20% annual growth rate, and so really it's only a matter of time until these market surpluses are replaced by deficits. And really, different market commentators predict those deficits at different periods, but it's all towards the end of the decade. And the good news is that this is a large strategic project in a good location in the United States, and the timing is poised well for these eventual market deficits when they emerge. As I've touched on, and we'll unpack a little bit more today, is being a US project, there's a bunch of unique strategic advantages, being the tax incentives, but also large government potential for large government funding and whatnot. So if you bring these two elements together in terms of a strong PFS, with the project located in a jurisdiction that is looking to really incentivize large chemical projects, combined with a market recovery in the medium term, we really think that McDermitt and Jindalee represents really compelling value. So we're excited to walk you through the results of the PFS today. In terms of the technical overview, I'm going to use the Verify 3D fly through today, really to walk you through the project and bring it to life. But before I talk through the nuts and bolts of it, I really wanted to highlight the quality of work that went into that, the PFS. We'll talk today a bit more about our partnership strategy as well, and really that's influenced how we approach this PFS. We believe is a really high quality piece of work. It was led by our lead engineer was Fluor Corporation, and that choice was really deliberate. They're a global engineering and construction company headquartered in the US. They built a lot of projects in the US across different industries, and importantly, they're heavily involved in, I guess, the two most advanced US lithium sedimentary projects. So They've led a lot of the metallurgical test work that's fully validated our flow sheet and produced battery grade lithium carbonate this year. But they've also pulled together the capital estimate and been through their global review process. So we're very happy to stand by this, and we think that'll stand up to the rigor of due diligence from potential partners. We'll get into next steps a bit later, but really, the next phase of McDermitt's development will be achieving our exploration plan of operations, a large infill drill program, a feasibility study, but I'll place that in context a bit later on once we get through the results of the pre-feasibility study. As Lucas mentioned at the top, McDermitt's located, in the western United States. So it's on the border of Oregon and Nevada. It's currently the largest lithium deposit in the US. It's head and shoulders above, the Canadian spodumene deposits. It's very similar in size and scale to our more advanced neighbour in Thacker Pass, owned by Lithium Americas. They're a circa billion dollar company and are currently under construction. The project is, as you'll see on this next map, is ideally located with proximity to infrastructure. So given the large scale of the project, that's really important. There's rail infrastructure through Winnemucca. There's a highway that runs through the township of McDermitt, about 30 kilometres from the project, and there's power lines there in green that you can see. Equally on this map, the red oval is the caldera, being the top of that previous volcano and the geological feature which hosts both the Thacker Pass project and our McDermitt project. Zooming in now to our project, really the orange outline here highlights the outside of our claims, while the blue line is our resource. And the story behind our resource at McDermitt is quite an incredible one. We pegged the ground in 2018, and then through COVID, through a number of drill programs, built it out to the largest resource in North America through a resource update in 2023, and then we commenced the pre-feasibility study the middle of that year. Just to demonstrate the location here, I'll just move this map around. You can see we're about 30 kilometres from the township of McDermitt. If we spin around a bit further on the map here, you can see, if you follow this blue line, that's the edge of the caldera roughly, and Thacker Pass is roughly where that cross is. The other key point I wanted to make on this slide before we move on is to give a bit of a feel for what the country like is up here. It's known as sort of a high desert region. And if you have a look here, it's historically been a lot of mercury mining in the region. You can see in this picture here, there's an opalite mine right adjacent to our claims. Our claims are in the background behind that. Old workings that are clearly been left derelict. And if we have a look on this image here, really just gives at least a feel for the viewer on what the country looks like. It's been heavily ranched for for a long period of time. So the land use up here has been sort of cattle grazing. Now, quickly moving on into just to give you a flavour of the township of McDermitt. It's a small township that previously prospered under mercury mining the middle of last century. We are sort of embedded in the town. We have a house in town, but we also share a shed with the local fire department, which is our core shed. And that's our VP of exploration and development with our core there in the township. But moving on to the PFS. Really, the project consists of a shallow open cut mine and a processing facility to produce battery grade lithium carbonate. I'll step through the mining first on the next slide. And for context, there's a section on the next slide, which is roughly that blue line through there. The mine is, it's a really unique ore body, I think is the first thing to say. It's much different from spodumene projects that I guess Australian investors are typically used to seeing. Very shallow, very soft ore that's near surface. And as a result, we have relatively low mining costs. It's free dig ore. The bond index is in single digits. And over the life of our project, we expect the strip ratio to be sort of circa 1.3, and that's really, only targeting 2 out of the 4, units in our deposit, and they're the ones that carry some higher grade and favourable metallurgical properties. And it also allows us to target a stockpiling strategy, having a stable mining profile over sort of circa 40 years, where we target processing higher grade material around that sort of 2000 ppm material through the plant, and allow lower grade material to be processed at the back end of a circa 63-year overall project life. And the cross section really just really illustrates that how close the ore is to surface. And I think the next slide here will sort of demonstrate it as well. That really those sort of ore blocks there are greater than 2000 ppm that are near or at surface within the pit shell. And so it really just demonstrates that our sort of the processing and mining schedule targets those materials, which really underpins that strong production profile. Sorry, you just move back 2 steps here. Sorry. Before we get into it, I think the mining is a key part, but then the flow sheet. There's 2 parts to the flow sheet. There's the beneficiation, and then there's the lithium carbonate plant, as you can see on this plan here. I'll walk through each one in a little bit more detail, but I think the important thing to highlight at the outset is that the processing flow sheet consists of standard technology used throughout industry, and McDermitt will be sort of a fully integrated operation producing lithium carbonate for sale to US customers. And that's a really key differentiator. It's not a dig and ship to China project, as is the case in a lot of our sort of, say, WA peers, where the spodumene gets concentrated and shipped to China for production of lithium chemicals. The US has sort of bipartisan focus on domestic manufacturing, and they really want to have this security of supply over the long term, and that's really the strategic value of McDermitt, given the size and length of the operation. Now, just to step through the sorry, I'll just in terms of the beneficiation, as I touched on before, that's the first step, and what that involves is essentially washing the ore. As I said, it's very soft material, and through this step we screen off the coarse gangue material and keep the finer clay material, which is associated with the lithium. And through this process, we lose about 25 to 30% of the overall mass, but keep the vast majority of the lithium, in order of, say, above 90%. That really upgrades the feed into the processing plant. If we move across here, this is the processing plant. The first step here is acid leaching with sulfuric acid. It's an atmospheric leach at relatively low temperatures, and then that brings lithium and some other metals into solution. And then there's a number of different steps to remove those different metals, specifically magnesium and calcium in particular, before it's purified into a lithium carbonate product, ready to be sold into the battery industry. The key bit to highlight as part of this processing plan, and it forms part of the capex as well, is that there's an on-site acid plant. So we're not importing acid, we're importing sulfur. That acid plant turns the sulfur into sulfuric acid, but through that process, it also creates a lot of energy, and will produce sort of circa 80% of our site electricity needs, as well as some of the process, steam and other inputs into the process. The key, when we think about the mining and the processing, really the project is much more of a chemical project. The overall capex budget, there's only a very small fraction of it relates to the mining. The vast majority is the process and non-process infrastructure. And then equally on the OPEX side, 72 or 3% of the operating cost is associated with the chemical plant. The mining is a relatively small portion of the cost, and so then that's reflected in how we look at the opportunities identified in the PFS. Any opportunities that can reduce acid consumption, produce byproducts, etc., really have the potential impact to improve our cost position. And that's really I'll touch on some of them later, but that's the real focus of us moving forward in some of our partnership collaborations with different entities. So bringing it all together, what does a production profile look like? Over the first 10 years, the plant's designed to target 47.5 kilotons of lithium carbonate production per annum, and we hit that for the first 10 years, with the bottleneck being that the acid plant that I spoke about previously. So as the grade comes off over the preceding three decades, we hold a sort of above 44 kilotons of lithium carbonate over out to that sort of 40-year period. The PFS, it's really important to highlight that the PFS financial parameters are based on those 40 years of production, but our actual PFS project plan has been done in detail over a 63-year mine life. 63-year project life, with the production sort of tapering off after that 40 years, reflecting the lower grade out there. And it just really reflects the optionality we have with this large project in terms of future drilling to firm up higher grade material to sort of extend that processing schedule, or opportunities to target the other units in the resource and or expand processing capacity later in life. And I think the last point I really wanted to make is that this is the current PFS reserve is in the order of 2.34 million tons of lithium carbonate on a resource base of 21. So we were using about 11% of the current resource, which just indicates how much latent value that we can potentially unpick as we continue to understand the project in a bit more detail. That's our current resource, but I'll just skip through to the zoom out here for the visual, and I think that just really highlights that's the pit against the extensive and indicated and inferred resources. And then we quite cheekily we put in the Las Vegas strip here just to sort of indicate the scale of the current resource. So in terms of project economics, the PFS really demonstrates that once in production, it'd be a really high margin operation without counting a lot of the future opportunities that we see. Importantly, it'll be resilient to the low lithium price cycles. Currently, today's suppressed lithium price would generate sort of 17 to 20% free cash flow margins. And importantly, long life projects, tend to, have the ability to capture multiple upswings. So, we think it's a, attractive asset from that perspective, is that it'll make money in the low cycles, but really generate outsized returns in those upswings, as we've seen with, some of the recent producers in Western Australia, like Pilbara Minerals. Importantly, it will provide significant economic contribution to the region. It's going to provide, a number of jobs both in construction and in operation, and provide a lot of economic development to the region, which has been sort of historically disadvantaged. And I think the key point I touched on, and it links to the next slide, is that we think there's really scope to improve these numbers as we go forward. And I guess just briefly talking to some of these opportunities that we've identified as part of the PFS. The key one is around the process optimization. Every bit we can increase the grade into the leach feed really reduces the key cost inputs in terms of acid consumption, etc. So the ability for us to further upgrade through the beneficiation process, potentially really drives value. And similarly, there's other potential benefits in terms of extracting co-products. One of the waste streams at the moment from the process is magnesium sulfate, which is Epsom salts, which are agricultural product, and subject to future market studies and test work to produce that at the right quality. That there's a potential material co-product credit. Additionally, our focus is, we've got a heavily ESG focus. For this project to be a success, it really needs to create value for all shareholders, so all stakeholders, I should say. And we've recently executed a agreement with the Department of Energy in consortium with some local universities, as well as the Oregon Mines Department. And that work, it's early days at the moment, but the scope of it really is to improve, the cost and sustainability outcomes of McDermitt, looking at some of the process optimization stuff I just spoke about, but also some of these byproducts and sustainability improvements, like reducing water usage, improving tailings disposal, etc. So we're really excited about the potential of that work. In terms of the pathway forward, we've completed a permitting roadmap as part of the PFS and understand the steps required and the critical path ahead. Similar to our peers, the project is located on federal land managed by the Bureau of Land Management, part of the US Department of Interior, which, together with completing baseline studies, is expected to set the critical path. And as I sort of alluded to previously, we've got a strong ESG focus. We've conducted extensive baseline studies since 2022. We've recently executed some tribal agreements. We've appointed some key team members in the US, including an ESG manager to drive that effort forward, because these areas around permitting we expect to be the critical path. And with the year ahead, we'll touch on it later, but the exploration plan of operations is well developed. We expect to receive that permission next year, which will be the key step from a technical point of view to take the project forward, because it'll allow a large infill drill program and associated study work to continue. I guess a bit more on the time frame. Really, that highlights that the permitting process we do expect to be the critical path, with the engineering studies falling in line with parallel with them. And really, the top of the line there around partnerships is what I really want to unpack next. So we think that's the key to taking this project forward. And I'm going to just talk to a bit of the context around the current market for partnerships first. I think there's a real disconnect in the market at the moment. We're seeing we're seeing a disinterest from generalist investors in the space. But conversely, we've seen big players start to make bold moves. Seeing the bottom of the market, we've seen Rio Tinto acquire Arcadium Lithium at a significant premium. We've seen Pilbara Minerals acquire Latin Resources, which was a late stage developer in Brazil at a significant premium. And more importantly and more relevantly to us, we've seen strategic players in the value chain continue to be active in funding both the development and the pre-development of greenfield projects. Of particular reference and context to Jindalee and McDermitt is on that right hand side there, that Thacker Pass example. I've highlighted them on the map previously. They're our more advanced neighbour, very similar size project, both in terms of production and capital. They've recently closed a 2.2. They're also a single asset development company. They've recently closed a $2.26 billion loan with the Department of Energy, and they've struck a joint venture and other equity investment with General Motors to the tune of $950 odd million to fund that project, and with General Motors making their last commitment in the last couple of months really indicates, despite that softening outlook on Chinese spot pricing, that North American OEMs and supply chain remain committed. The example next to them is a very similar one in terms of Ioneer and Sibanye-Stillwater. They've got a joint venture, and Ioneer also has a significant loan with the US Department of Energy. Both of which I should say, very favourable terms, being treasury rates and very long tenure loans that aren't seen elsewhere in the mining project finance space. But probably the most relevant to us is that pre-development phase. We're not, for Jindalee, we're not looking to raise the development financing tomorrow. Really, it's about how do we create value and continue to progress the project by continually de-risking it and progressing it towards production. And really, those pre-development funding agreements are, speak to our strategy. All of those involve, strategic groups funding pre-development work programs, be it drilling, study work, etc., and help bring a complementary skill set to two smaller entities to help accelerate those projects. And the first big three on that list are sort of akin to where we are at. Before I just unpick our specific strategy a bit more, I think really want to give a bit more context on the US. There's a lot of noise in the system, but I think the US OEMs are laser focused on catching up in electric vehicles, irrespective of subsidies. They know that they're the future, and I'd encourage shareholders and listeners to listen to particularly Jim Farley, the CEO from Ford, some of his interviews. Really, the direction of traffic is not changing, and they're fully committed to bridging the gap on their EVs. Separately, there's sort of really strong bipartisan support to decouple critical mineral supply chains from China and increase domestic manufacturing jobs, and this will only increase under Trump. And we've seen, he really kicked off the US critical minerals thing at the tail end or in the second half of his first presidency, and we expect a lot of the noise that are coming out of that camp, that there'll be a focus on that domestic jobs and onshoring, not friendshoring. So I think that's all very positive for projects like McDermitt. So what does that mean for us? Well, partnerships are nothing new for Jindalee. We've had since last year, we've been doing work with POSCO. We're doing test work in Korea. Like I mentioned, we've cut a deal earlier this year with the Department of Energy, to do research and development on McDermitt. And looking forward, really, we're looking through a partnership lens from a couple of different angles. One is to help integrate it into the supply chain. It's a large chemical project. It's not going to produce a commodity style product. It's a specialized product that needs to be built into future supply chains. So it needs to have those partners involved with the right skill sets to be able to and customer relationships. Second of all, we want groups involved that have a strong US presence, that have that sort of complementary skill set in terms of technical capability, but equally from a balance sheet point of view, be able to shape and fund the next stage of work on McDermitt, but also position us in the best possible position as a project to get the eventual development funding in a couple of years' time. And that's been a real, if you look at some of the pre-development precedents that I touched on, really the key theme through that is these partners coming in, typically in a joint venture or offtake structure, and they're working with the junior mining company to really put in place a financing plan to be able to finance a project in a number of years' time. And I think probably the key point I want to close out on that is, actually I'll link it into the next slide here, is really for the tail end of this year, we're looking to appoint sort of strategic advisors to help assist us with this partnership process. And we're sort of conversations advanced with a couple of those groups at the moment. We're also looking to get an update regarding our DoD grant funding application. Shareholders might recall that we have a DoD grant application which potentially co-fund the next phase of work, including a drill program and feasibility study. And we do still expect an update by the end of the year, and with a view that and in terms of a plan A scenario would be if we were successful in the Department of Defence funding, together with potentially some incoming partnership funding that would fund us through the next stage of work. But really, in terms of the near-term milestones looking into next year, we're going to continue the key on-the-ground permitting activities and ESG community engagement, etc., which as I've sort of mentioned earlier, is really key, and likely our critical path. So we'll hopefully get our exploration plan of operation approved by the middle of the year, which will allow us to potentially do a large infill drill program commencing in the second half of next year, which we'll consider as we progress the partnership strategy, which will involve engaging with partners more deeply, probably commencing early this year. Later this year and early into 2025. And really, we specifically sort of split off that the 2025 program there. We have an understanding of what's required to take the project forward, but really, any incoming partner will obviously help shape exactly what that program looks like, and so we've got the optionality to push forward on them depending on the feedback out of that partnership process. That brings me to the end of my slides. Happy to open it up to Q&A, or Lindsay, if you wanted to make any closing comments.
Yes, thanks, Ian. Look, the main thing I'd just like viewers to understand, and you did touch on it, Ian, but it's really important, I think, to emphasise it. The project currently has a 63-year life without drilling another hole and increasing the reserve further, and we're very confident that infill drilling will convert inferred resource to indicated, and therefore allow that to be converted into probable reserve. But be that as it may, where we sit today, we've got a 63-year life project, but the financials only cover the first 40 years. So it's important to understand that because of, at the request of the ASX, we we haven't forecast the financial metrics for the project for the full project life. We have only forecast those for the first 40 years. And also another important point is that the project has a payback of 5 years. You know, and considering the scale of this project, that is actually a really short payback period. And that is, as Ian mentioned, because we're targeting the higher grade ore, which has more favourable metallurgical characteristics first, and that really allows a rapid cash flow generation at the front end of the project. So they're probably the main points that I'd like viewers just to. I'm kind of, you know, re-emphasising what Ian's already told you, but I think from you know, if you're looking at the value of the project, I think that's they're important features to understand.
Thank you, Lindsay and Ian. We'll move on to the Q&A section. The first question, how does a small company like Jindalee hope to fund the capital estimate outlined in the PFS? And the second part, I think you've covered towards the end of your presentation, Ian. Are you looking at partnerships and or can you access government grants and funding?
Well, I can build on, I guess, a bit more what I've said in the presentation. I think in the short term, our focus is US grant funding and combined with partnerships. You know, that's most likely to be some sort of offtake, you know, potentially joint venture style arrangement. I mean, that's typically used in, you know, these large projects, be it in copper or lithium or whatnot, for junior mining companies to have sort of a less dilutive and accelerated de-risking of the asset. And then by virtue of bringing in those partners, it really allows the future financing to be possible. And so really, you know, what would success look like in that for Jindalee on that would be, you know, partner or partners coming in through a transaction that would have them potentially get access to a portion of the offtake and or you know, asset level stake, and then, you know, really increase the chances of us really you know, getting the project financed down the track. So that's the, I guess, the short-term focus. And then if you were looking towards the development financing, I sort of touched on, you know, what do partners bring to the mix. You know, they help, you know, provide the credit worthiness to get, you know, some of this US government funding, whether it's through the Department of Energy, whether it's through the US Import-Export Bank, or whether it be other, you know, Asian export credit agencies. You know, they really allow, they bring a broader range of project financing tools into the mix. And they also, you know, obviously help de-risk the project from a customer perspective as well. And so really, you know, the final financing we sort of speak to a little bit in the PFS, in the sensitivity analysis. I'd point people to is that we've used, you know, I guess Lithium America's Thacker Pass as a bit of a proxy to, you know, as a what if analysis. So using, you know, their sort of headline parameters, they've funded in the order of 75% of their capital through a loan from the Department of Energy that's, say, 24 years in tenure and at US Treasury rate. So what does that mean? It's basically home loan money. Yeah, those sort of project financing facilities are not available from commercial banks at all. And you really supercharge the equity returns, which sort of, you know, you can have a look in the PFS for those sort of numbers. So really, the key strategy in a number of years' time would be, you know, locking down that debt finance piece, but having the partners in place to be able to do that, but then also put in place the offtake and equity funding required to fill the balance.
And I suppose just further on potential partners, we've had a question come in. Who do you feel might be the most likely potential partners? Obviously, it can be very difficult to say, but do you see miners or more likely sort of, you know, industrial, chemical, battery companies or vehicle OEMs as being the sort of most likely suspects as partners?
I think it's hard to say. I think we've had interest from various quarters. If you look at Lithium Americas, General Motors, obviously their partner and joint venture partner there, but they got involved, I guess, a bit more later in the piece. We've seen, the typical Japanese groups get involved, earlier in the process. If you look at the Frontier deal, there's been Korean companies like EcoPro get involved in earlier stage stuff in Canada with green technology metals. So we've seen the interest from different parts of the value chain, but I think it's the groups that are more comfortable with the earlier stage, that we're looking towards.
Okay. And how are you finding the local permitting process? Are you able to conduct the work on the project required within the existing regulatory framework?
Yep, I think key point to emphasise is that the it's federal land, so the lead permitting agency is the BLM, and then the local agency is the GAMI, which is the Oregon Mines Department. We've basically drilled every year since we've pegged it, and we're working through the exploration plan of operation. We now understand the the pathway to get the full suite of permits. There's another project in the same county, a gold project, which is very close to getting their final permits, and we're using the same advisors to them. So we've got a good handle on what we need to do, and I think the key takeaway there is is that we think the federal timeline will probably drive the federal permit process will probably drive the timeline, and a lot of the local agency stuff should happen in parallel. There is some optionality on the project. I didn't really touch on it actually in the verify, but some of our claims do sit in Nevada, so there is some flexibility potentially around where we locate infrastructure. But the current PFS is based on solely in Oregon, but that's, I guess, something that we'll consider moving forward.
Thank you. The next question: how do you plan to balance between more drilling and continuing work to advance McDermitt, whilst not trying to go to the market for more capital while the lithium price is still well below McDermitt's break-even level?
Yep. Good question. I think look, Jindalee's got a track record of preserving the capital structure. We've all got skin in the game, so I think there's a vested interest not to at these levels raise as little capital as possible in traditional equity, particularly given the backdrop. I think and that's what I sort of pointed to in terms of that, the infill drilling and feasibility study work. We've not made any firm commitment around timing for that, because I think we want it to be informed by the partnership process, and hope that that will drive the funding for that. So failing a sort of the improving in market conditions, the timing of that will be subject to what our key priority is. Driving forward is progressing those ESG work streams of permitting, community engagement. That'll continue in any case, because it's sort of really important and likely the critical path for the project. So that, and it's relatively low cost compared to drilling and feasibility studies, which will commence in due course. I think the other point to make, you touch on the break-even point. I think there are some questions I've seen that have come to us through other channels. Confusion around the break-even price, and I think just while I've got the microphone, I think the key point to make is that the break-even point we mentioned in the study is an NPV break-even point, which is after you which is theoretical break-even price based on the discounted cash flows to today based on 8%. On the flip side is that if it was in production today, it would make good cash from an operating basis, and that if you look at the long-term incentive pricing, which is required to justify new greenfield developments, the project generates a very healthy return. So I think it's just very important to understand the difference. It's not that we wouldn't make cash on a operating basis. It's more about the return on capital.
Thank you, Ian. And I know in your presentation, you sort of painted a pretty positive picture of government support under a Trump presidency, but we've had a question. Do you think there are any risks towards potential funding, particularly through the Department of Energy under Trump?
Look, I think there's definitely going to be changes in the structure of different incentives and funding programs, etc. But we don't think the direction of travel's going to change. I think the priorities are firmly on increasing, domestic critical minerals production, and there might be, if you have a look at where all the subsidies have gone under the IRA, very little has actually gone to critical minerals and the midstream. So we think actually the focus will shift towards both the critical minerals and the midstream being, the cathode part. A lot of funding's gone into gigafactories. So we think that'll be, that's a thesis at least. So we think that'll be positive, but it's going to take, obviously, Mr. Trump getting into office and firming up his policy objectives. But we think, he's, the intent that he's flagged, we think will be positive.
If I could also just jump in there too, I think we'll probably see a focus on accelerated permitting times as well under a Trump administration. Certainly in his previous tenure as president, that was one of his focuses in the second half of his administration, and I think we'll see him pick that up and run with it a bit harder, given he's got the control of all levels of the US government now.
Yep.
Thanks, guys. We've had a question asking you to detail and break down charges associated with the $149 million in the owner's costs, which are stated in the PFS.
Yep.
Are you able to address that?
Yep. Yeah, their owner's costs during construction. So essentially, full, and it's pretty close to the owner's cost assumed for by Lithium Americas in their estimate. But essentially, if you can imagine it, in a number of years' time, when we're ready to press the button, there'll be a large owners team to manage, what will be a, potentially multi-billion-dollar project. So really, that cost is the cost of the owners team over circa 3.5 years to manage those contracts, as well as some of the construction costs that fall into the owners cost line, as opposed to under the engineering contracts.
Thanks. And I think this will probably be our last question in several parts. How do the operational costs assumed in the PFS compare with Thacker Pass? And on Thacker Pass, would Jindalee ever consider a partnership with Lithium Americas? And would McDermitt ore be able to be processed at Thacker Pass?
I'll start with the operating costs. I think they're hard to compare because I guess the feasibility study costs for Thacker Pass assume ramping up to doubling production and includes another wedge of capital. But if you just take their unit costs on face value, but obviously the higher scale would generate benefits from a fixed cost basis. But just using their unit costs straight out of their feasibility study, and ours is about 20 to 30%. Ours is 20-30% higher, which sort of would be expected, given that we're starting with a lower grade, albeit our recovery is a bit higher on the basis of our test work. So that's the best steer I could give on that. The capital intensity is about the same. In terms of tie up with Lithium Americas, I think they're dead focused on delivering their current study. I think they also hold significant land holding in the southern caldera. They've got, as I mentioned, they've got a staged development plan that they're really focused on at the moment. So they've got to deliver their first phase, and then potentially, so that's a first phase of 40,000 tonnes a year, and then a phase 2 to double that. And they've got, off their current, resource base, they've got plenty to do that. So I don't think, their, near-term priorities, they don't need feed. They've got surplus feed from their own projects. So we don't really see that there's a real compelling rationale around I guess that suggestion. And whether it could be fed in there, it's broadly a similar process in terms of sulfuric acid leaching, etc. But too hard to say whether it could actually be processed there. But sorry, the other point I make is that logistically it probably wouldn't really make sense in any case because of the distance involved. Really the benefit, one of the benefits of this style of deposit is that it's a reasonably efficient way to get to lithium chemicals. Unlike the spodumene route, there's no calcining, fine grinding, flotation, etc. But the downside is that there's no neat readily tradable concentrate product. We upgrade the feed into through the beneficiation process, but there's not a spod con that can be put on a truck.
Okay, well, that appears to cover the majority of the questions from the audience. If you do have any additional questions that were not received, please don't hesitate to email them to info@corporatestorytime.com. I'm just asking Ian and Lindsay if you have any final comments.
I just thank everyone for attending, and like you said, Lucas, if there's any other questions from investors, more than happy to answer them directly. So thanks for your time.
Yeah, I'll just echo Ian's comments. Thanks everyone for your interest. Look, it's a huge project. Jindalee is a very small company, but it's delivering this project has the potential to deliver outsized returns for our shareholders. There's phenomenal leverage from where our current market cap sits, so thanks for your support, and hopefully we'll be able to make good on our goals here.
Well, that concludes the webinar, and I thank you all for your attendance. Have a good day.